So this is the video for 5 August through 9 August. Now, we are in a correction, okay? Don't call it a crash. The indices are definitely not down 20%, not a crash, but we're in a correction. Now, going over why we're in a correction, there are many, many reasons, but a big one here is called the SAM rule. Now, in the case we're in right now, we have unemployment 0.5% higher than the last 12 months, okay? So that's a big issue, and that's in terms of the 3-month moving average. My opinion, we're going to see unemployment cap off somewhere between 5 and 10%. 10% would be pretty bad. 10% pretty bad. And then one problem with unemployment is very, very sneaky because unfortunately the government doesn't care about wasteful spending that much. So the last couple quarters, you would see very deceptive job reports where a lot of government jobs would be added and low-wage illegal immigrant jobs. Those two have massively distorted the jobs reports. Thus, you could argue, based on earnings from other companies for really the last 2 quarters, that we've had multiple pre-recessionary actual indications. Now remember, a recession textbook requires 2 back-to-back quarters of negative GDP growth. We are not anywhere near that just yet, technically, but give them time. I don't be surprised if we have those 2 quarters of negative GDP growth. Technically, we had a tiny little recession back in 2022. Now, as far as a week ahead, I'm changing this so that it reflects both the very short nano term as far as the earnings themselves, while also giving some of you guys who are strictly longs ammunition to play with. I want to make sure this is useful for traders and investors. So compared to previous weeks, we have dividend yield and we have free float market cap on here. So both of these are very useful metrics, especially for longs when it comes to dividends. The beauty of a dividend yield is if you can buy a stock, it's a healthy company that's not going to cut the dividend. Even in rough times, you can just sit back, relax, just chill, collect your dividend. So for Monday, the only small buy I'd potentially do is CSX. Great balance sheets. They usually beat earnings. They're a little undervalued. It's a very nice setup. Simon Property Group, definitely a shorter sidelines. Not the easiest short. That's why it's kind of distinguished between sidelines or short. Some of these kind of a coin flip as far as what I'll do. Like for instance, the Palantir. Palantir is an example of perfectly fine to get in right now as a long, but that one I would almost guarantee will be more of a short after our earnings. Can't be sure, hence both, but in the nano term here, this week, the shorts to play for Palantir. I mean, they have a massive P ratio. 74 is pretty bad, pretty big. Fine for a growth stock long term, but growth stocks that are more better valued, I usually prefer PE ratios 30 to 50, but this is a 1-year PE. With growth stocks, another category I put on here is 2-year PE, which is also very useful. Really, with growth stocks, you need to actually have an outlook for multiple years if you're long. So just the 1 year's forward PE is not going to really cut it. Tyson Foods is on here, great company. I have it on sidelines here, but that is not a bad long. So another nice dividend, great balance sheet, pretty fair valuation. So either play with Tyson Foods is fine, but I would definitely just sit on the sidelines for that myself. Tuesday has a massive amount of companies, okay? So I'm not going to do every company, obviously, that'd take forever. Rather, we're just going to talk about 6 of them. Now, some of these are very, very easy. Uber is a beautiful short. That is a short I'm holding right now, actually. I plan on making good money on that. Right now, you're at a forward PE of 67.29. But here's the thing. What matters more in earnings than the actual valuation from the EPS and revenue is guidance. And the guidance we've seen from anything travel and consumer spending sector is pretty bad. I would be very surprised if Uber makes good guidance. They're probably going to lower the guidance and thus easy short. Builders first is a really tricky one. Okay, technicals have builders first, unfortunately, as a short right now, but it's a pretty good long. So if you buy it right now before earnings, probably go down. But it doesn't matter because if some of you guys who are just going to be holding a stock for a year plus anyway, this is on my list of pretty solid long. Just know that housing sector is going to get a little dicey soon. So construction, pretty risky. Same with Caterpillar. Caterpillar is a hard one to actually judge right now. I get seeing going both ways. So once again, Silence play. 14.9 forward PE is pretty good. And the thing is, a lot of these companies consistently do better than they are supposed to. Now, what's funny with the game here is a lot of companies will actually lower their guidance in the sense that they're pretty sure they can do better than what they're going to tell the actual investors. Kind of lowering guidance, you can kind of scam the system to make sure you win quarter after quarter after quarter, which is pretty important. Planet Fitness is an interesting one. So I'm actually definitely just doing silence in here. It's fine buy, not a great buy, but once again, I kind of want to have some of this for long. So if you are interested in a pretty fairly valued company, it's okay. I definitely see it going down though, so definitely playing silence in this one. Petman Express was pretty interesting. So I really wanted to call this a short, but their chart is actually extremely low in stock valuation. So much so that it's very hard to justify the risk reward of shorting Petman Express right now. Yes, they can consistently do a terrible job with revenue and EPS. However, you be very careful of dead cat balances and kind of a sneaky dead stock like Petman Express. So, in my opinion, not a great short. Could be great, could be okay short, but gotta have strong risk management. The Airbnb is a tricky one. So I'm saying silence again for this one as well. Not a terrible entry point for you longs. Could be a fine short though, but it's, in my opinion, even if we are becoming a bearish market, you have to be a little more cautious of shorts than you do a regular buy. Because usually, unless the company is trash like Petman Express, the stock will bounce back, and they tend to bounce back very heavily, very fast when you have these bear markets. So be careful. Make sure it's a good, sure short, like Uber, for instance. Airbnb is tricky. I'm not a fan of it, but I'm definitely more on the sidelines play there. Now, we go into some interesting ones here. Disney is very tricky. Balance sheet, not very good. So they have a pretty rough balance sheet. That's why I'm more on the sidelines here. But at the current stock price, if you buy long, you're going to make money eventually. But this is a long where you're going to have to be okay holding the stock for years at this point. So definitely going to hold for a long time, and not a very good dividend yield. So you're going to have to deal with kind of holding not exactly trash, but not really a great company either. But I do see them kind of flipping the switch and doing well in the future. But when's the future? I can definitely see these guys going down after earnings too. But it's tricky. I mean, for Disney, they're actually a very, very low PE ratio. Disney's more of a 20 to 35 PE usually. Right now they're all the way down to 18.3. So there you go. Hilton is a easy short. All right, so now these companies are all interconnected. What happened to MGM last week? MGM reported dumpster fire earnings, stock dropped some 17%. Usually these kind of companies play off each other. Hilton is probably going to do pretty poorly because the travel sector is not very good, but they have a fairly high valuation still. Easy short on multiple levels. CVS is tricky. So what I'm going to do with CVS is, because the PE is so beaten down to 8.5 still, and I mean the price to sales is 0.21. So once again, PS will actually give you a good feel for revenue per share, and PE is overall earnings per share. So this is more useful because obviously you have a company make a lot of money, but the same company might have a ton of debt payments. They might have a ton of legal fees, ton of G&A, which is administrative fees. You never know. So this is obviously more useful, but revenue still matters as well. So I like the company, and I like this. I like this. It's very nice. 4.48% is fine. It's fine dividend yield to hold for long. So, and pretty solid balance sheet. Warner Brothers Discovery, very tricky company. It's hard to short because it's so low, but kind of a dumpster fire. Although I will generally err on the side of caution. So sidelines play. Robin the Hood. Is your hood robbed? Probably will be if you use Robinhood. Not a very good broker. Now, Robinhood is a tricky one. So I would say sidelines are short for this one. Fairly high valuation, but it's tricky. And I would still say mostly sidelines because the financial sector is not getting hit as hard as these other ones. So we're getting hit a fair bit. We saw SoFi and a couple other companies, but overall, not the worst sector right now. Okay, growth stock, PE ratio. So probably best to err on the side of caution, just to send aside of that one. Thursday. Got a couple big dogs here. Eli Lilly. This is a tricky earnings play because the stock's gone down about almost 300 points since the all-time high for Eli Lilly. Eli Lilly is a very good company with very good products. And looking at earnings last week, some of the healthcare stocks actually still popped up on earnings and did okay. That sector was not hit nearly as bad as the other ones. So Eli Lilly's tricky. Okay, tricky. Err on the side of caution. I would love for Eli Lilly to go down, and that'd be an example of stock I would try to start buying shares. I've traded that one back and forth. I've bought shorts in Eli Lilly, but right now I'm not shorting Eli Lilly. I made a lot of money on Eli Lilly shorts. So I play both sides of that one. Great trading stock, but sometimes you just want to actually see the earnings. Paramount is tricky. Okay, so it's not the best short, but if you look at it versus some other companies, it's still a little high. So you could short it if you want to. I would probably just set a sidelines for that one as well. 18.18 is meh as far as a PE ratio. And once again, another company that usually beats earnings, but the guidance is tricky. Guidance is kind of tricky for a company like Paramount. I could see it being bad where you have a recession, people are not going to pay for Paramount Plus. But I can also see it being kind of good in the inverse where people decide, okay, well, recession, I'm not going to go watch the movies as much. I'll watch a couple Paramount movies, but I'm going to keep watching Paramount Plus so that I can have fun. So watch Paramount Plus shows. So very trickier stock than you think. Probably sidelines there. Gilead, definitely sidelines because it's a good company. And it kind of falls in that Eli Lilly category where Gilead or Eli Lilly, both of which I've won before, I will probably buy after earnings if the company goes to shit. Because the easy buys and kind of hold for a while. Okay. Expedia Group. Expedia Group's tricky right now. 9.89. Okay. On still technically a small growth stock. Not a huge growth. They don't do much year over year as far as revenue growth. They do still do a little bit, but below 10 is too risky to short this stock. Okay. So I'd rather just have a small buy, maybe have to hold for a year, get those juicy long-term capital gains tax rate, and call it a day. So, but once again, If you buy a stock right now, you gotta be willing to hold that stock for a while. Which also is why if you play with a margin account, most of your margin account by definition has to be more short-term stuff. Because if you hold it long for a long time and the stock does go to shit temporarily, you got margin call to death. So bear that in mind. Take two. Tricky. I'm not going long with this one. You could. Solid company. But I'll just go sit in silence for that one. Now Friday. Friday. These are weird stocks, okay? They're all kind of tricky and they're all kind of unique. Canopy Growth. As I said before, I do not like marijuana plays unless I'm playing politics. The only time I'd really do a Canopy Growth or a Tilray is if Harris becomes president. Harris becomes president, you buy marijuana stocks, okay? You'd be dumb not to. You're always going to have those first 2 months, sometimes first 3 months after the presidency, the stock prices will ramp up for stocks that are Democrat or Republican stocks primarily. Canopy Growth is definitely in the Democrat house. So, groovy company loses money, doesn't matter because, remember, momentum plays are huge. And there's nothing more momentum than a presidential election. But right now, it's in the silence. Berry Petroleum. Ugh. Okay, so I put this on here partially because this is an example of a dividend stock I would not touch. I would not touch this. You look, 12.07% dividend yield. That's beautiful. Ah, that's only beautiful if they keep the dividend. Balance sheet not very good. Their cash equivalents on that balance sheet, they lost 25% of their cash in that 1 year. Not very good. This is what you call a risky dividend stock. Do not get risky and go, okay, I love this huge dividend yield. And then you lose your ass. These stocks crash. Even with an 8 PE. This could be a 2 PE. They cut the dividend yield, okay? So, you don't know. But it's still risky in the sense that it's not a good short because the P ratio is pretty low. But here's another thing. This is a petroleum company. How does petroleum do in a recession? Historically, always does shitty, okay? Petroleum plays do not do well in recessions. So, I would be expecting a Berry Petroleum. And the big guys like your Exxon, Chevron, Oxy, they go down in a recession. Oil always goes down in a recession. Last one is in Burr. Defense stock. Tricky stock. Still silence, probably. Once again, you can kind of see it go either way. So, err on the side of caution. Makes good things happen. So, that's the end of the video. Quick investments. And going forward, I do plan on having a video for every single one of these actual week ahead type scenarios. So I'll still post individual slides as well, but some of you guys like videos more, so video it is. Have a good week. Happy trading.